Major funding for these broadcasts is made possible by grants from Capital One Bank, New York Community Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, Ariel Property Advisors, Dime Community Bank. Additional funding is made possible by grants from AM Trust Title, AVR Realty Company, Avison Young, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Commercial Mortgage, Citizens Bank, CPEX Real Estate Services, Colliers International NYC, Cohen Equities, Collins Building Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Meringoff Family Foundation, the Moynihan Organization, Moynihan Capital Partners, and these friends.
In a game of Monopoly, there was a bank, and every time you pass go, you collected $200. So where the money was utilized to buy real estate. So the question today is there a lot of money for real estate? So I've today assembled this group of 4 banking executives to provide their insight on money for real estate. My guests include Brad Dubeck, who is the market executive for New York and New Jersey for Bank of America Merrill Lynch. Chris Niederprun, who is the managing director for CIT Real Estate Finance, CIT Bank. Paulo Garcia, regional manager for Mercantile Bank. And last but not least, Ron Hartman, executive vice president, commercial real estate for Flushing Bank. So we have basically a bank that was once a savings bank, who's a commercial bank. We have basically a commercial bank over here. We have a finance company bank, and we have a bank and an investment bank. Is there money for a lot of real estate, Mr. Dubeck?
There's always money for good real estate and for good clients. And we've done quite a bit of business this year as an industry, and next year we expect pretty much the same.
Now, I was at a seminar that investment sales are down by 50%. If investment sales are down by 50%, how could we be doing so much financing? Chris?
Well, I think that's part of it. Is investment sales in New York are down 50%, probably down 25% nationally. So there's probably the same amount of capital that was in chasing real estate in the last year or two, but chasing fewer transactions. So it's a very liquid market right now.
You know that the investment sales being dramatically down from years prior, it's definitely affecting our ability to put out loans out there. If you look at the New York City market, and particularly if you look at our portfolio for the past 3 years, in 15 and 16, 50% of our financing was acquisition financing. So with investment sales down 50% by some accounts, in 17, most of what we've done, if not all of what we've done, has been refinancing and a little bit of construction. So we definitely need the investment sales market to pick up again so we can get the quotas and production
Ron,
numbers that we're getting
you?
in years prior.
Well, we're the
like,
local,
You're like the local, safe, stable guys, right?
right? And we're still seeing our bit of activity since we're in the most active market.
Has 2017 been a slower year than 2016?
A little bit slower, but because we do have a variety of products, we're hopeful to still hit our billion-dollar mark of lending, which we've done the past couple of years. You know, we have a unit that does the small mixed use, 3 stores over 3 apartments over a store, and they've picked up a little bit on their side. We have a business lending unit who's picked up a bit on their side, doing C&I lending and lines of credit. And then there's my group that does the commercial lending. And we've been fortunate to have some active investors that we have had the relationship with for years who are refinancing, and we've been able to move along with them. So we've been fortunate in that respect.
You know, your highest profit as a banker is really where your highest risk is, in construction financing. Are there good construction deals out there today? Chris?
Yeah, there are good construction deals out there. I mean, I think Brad made the point earlier. I mean, you know, for the right sponsors, for the experienced developers that have access to capital, you know, there are still good projects that I think.
So here's the tough question. Everybody wants to be the next Steve Ross or the next Steve Witkoff, or, you know, the next mega developer, or, you know, the grave digger, our friend over there. Everybody wants to be there. How do you make a determination on that young developer? How do you sit there and say to yourself, I'm going to make a little bet on somebody? Brad?
Well, look, it's important, I think, for all the banks to bring in new clients. But I think most of the banks, as opposed to the non-banks, you know, don't take that many risks when it comes to, you know, undercapitalized or inexperienced sponsors. So I think if a sponsor, if a developer has institutional record working for a larger shop and is out on his own, maybe he has the experience that sort of checks the box for banks. But and I think most of the non-banks are picking up a lot of that sort of profile sponsor.
Yeah, I agree. It's very difficult, you know, as a regulated bank lender, to take that kind of risk on, you know, someone who does not have the development experience. Now, that said, you know, oftentimes we'll look for that developer who's going on his own now. He's had some experience, to Brad's point, with, you know, another development firm. He's well capitalized. He has good equity behind he or she. We take some comfort in that. They've done their diligence. They're going to invest their institutional capital alongside. So that's helpful, but it's difficult to take that risk.
Paulo?
Yeah, the track record is fundamental. Not only the track record, but also the financial wherewithal, especially when you're doing a construction loan. Now, what we have sort of done in the past has been to underwrite not just the developer, but the partner. Mm-hmm. But somebody has to take that risk with that young developer, right? So in essence, you know,
it's like the catch-22. How do you go to the next level? Now,
right.
In the multifamily, in many cases, multifamily lenders really look at the assets more than they always look at the developer or the owner. Am I correct?
Well, as far as our type of multifamily lending, you know, we've been active in the boroughs with mainly a lot of rent-stabilized buildings. So we're looking at those opportunities. We've always stayed away from the high rent districts ourselves. We look at those rent-stabilized buildings, a very conservative, safe bet. There's still room for those rents to grow, and that's what we're underwriting on.
Right. So you're underwriting more on the asset than on the sponsor level. In the rent-regulated multifamily area, as one would say.
For the most part, but if we're the more aggressive we can look at a deal, it has to have the very strong sponsor behind it.
You know, there's a good and bad of e-commerce. E-commerce has helped the industrial market. It's hurt the retail market, okay? Where's your perspective today on financing for retail?
Well, we're pretty active in the local active corridors in the boroughs with the mom and pop shops. We don't see that the e-commerce is going to crowd them out.
Right. You see, New York City is under-retailed in general, okay? So there's a need. I mean, if you look at Queens and, you know, you have a little exposure in Long Island City, so do you. You look at that and you say, Long Island City has a lot of residential. What they lack completely is enough of retail. They don't have small retail, not over there. So to do a deal in Astoria or Long Island City with a reasonable retail tenant, it's fine.
Yeah,
But
no, and I would agree with what Ron just mentioned. There's definitely, especially here in New York City, some retail corridors that are very strong. And you not so much look at the credit of the tenant as the market on that corridors. Are there vacancies? How's the foot traffic? And talking about the particular submarkets, Long Island City, downtown Brooklyn, I would actually be a lot more comfortable financing retail, say in a downtown Brooklyn, than I would be financing multifamily rental buildings right now. So there's definitely opportunities. You just got to look at the different submarkets.
And depending on the retail corridor where you are and the demographic in the area, right? A lot of these locations haven't been penetrated as heavily by Amazon, right? We sit and think about Amazon's taken over the world, right? But if you don't have a doorman to get your packages, are you ordering from Amazon? Maybe not, right? You're probably...
See, but Amazon has already taken that into consideration with something called Amazon Lockers. Amazon Lockers, I knew about it, and the other day I passed the Whole Foods, and at the entrance of the Whole Foods store were these lockers where you have the Amazon locker so you can pick it up.
Yeah.
And within some apartment houses even today, Amazon is building, at the entrance of like a small tower, small building, the locker so they can use it. So it's true, but I think there's a question of what people want, what they want by e-commerce and what they don't want. I mean, there's a big question about the fresh direct, the grocery, the fresh food. But someone said the other day, I was watching a show, they said, you know what, I paid $35 in delivery charges eventually from all the fresh food. So, there's pros and cons. How do we look at the condo market today?
I mean, overall, the headlines are all, generally poor. But I think when you look closer,
if the headlines are that way, how do you go to credit committee when the headlines are doom and gloom, Dr. Death?
well, you have to go beyond the headlines, just like you're underwriting any other sort of transaction. The middle part of the New York hospital or the New York condo market is still fairly healthy. We see sales of units under $3 million to have quite a bit of momentum. And then it's really looking at neighborhoods and going back to sponsors, the ones that have the track record and the experience selling condos successfully. And when you add all of those pieces together, you can make the case, even in this environment, to advocate for new condo.
The office market is a little weak in the city today. The TI is up significantly. The amount of concession for a couple rent is up, as you realize, because you just recently moved and signed the lease. How do you look at the office market? Not the brand new buildings. I'm not talking about a new construction of a building where it's 50% pre-leased, by Related or Silverstein or Durst, something like that. I'm talking about the other buildings, the B buildings or the C buildings.
Yeah, I mean, I think the challenge in that product is, it's old, right? It's not just that it's BC. It's probably BC because it's old. It's very old product, and it needs a lot of capital invested in it to bring it up to kind of modern standards with the technology, et cetera, all the offerings that tenants want. So those are challenging assets to underwrite.
Specifically, we could even say the office building you're in.
Yeah, absolutely.
Okay, you're on
Great
a prime
location.
42nd Street location, but that office building hasn't been really renovated in 20 years in many cases. It's low ceilings, and when somebody's looking, they may say, I can go somewhere else, and I don't have to be directly on Fifth Avenue and 42nd Street, and I can get a better bang for my buck, as they would say on that.
Right.
What's your thoughts about the transit-oriented developments in the suburbs of, let's say, Nassau and Suffolk County, where you are, Westchester, the Gold Coast of New Jersey, and so on, and even the Westfield area where you are?
Mm-hmm. Well, I mean, anything transit-oriented, I think, is good because, if people are commuting, being close to that transportation is a no-brainer. Some of the work they're doing in Harrison, New Jersey, for example, I think is very successful and a great price point compared to the Gold Coast of New Jersey and certainly Lower Manhattan. And the same thing is the case for a lot of communities that surround New York.
I know you were in Jersey City on a project that both of you participated on. How do you see Jersey City today?
So, yeah, 3 years ago we underwrote a loan in Jersey City, and there was a lot of supply in that market. It's been absorbed. I mean, it's amazing the inventory that's been absorbed. I think the market's very strong. It remains a discount, far and away discount to Manhattan, even to certainly to Brooklyn and Queens. So I think Jersey City is still a very viable development market.
Paulo?
You know, I agree with that. It's definitely on that particular project. It's been wildly successful. It's a large project, and they've absorbed you know, a good number of units in a relatively short amount of time. The question is concessions. You know, there continues to be a lot of concessions. It's not only a Jersey City phenomenon. It's happening
Brooklyn,
everywhere.
It's happening on the far west side also.
So we'll see how long that lasts. You know, it makes our job as bankers very, very difficult, because what rent do you underwrite? Especially, you know, the 3 months, the free rent. You can see that on a lease. But there are other things that, you know, developers are doing, where they're giving you an American Express card for, you know, and so that you can underwrite. That you have to really go into this rental office. You got to find out exactly what they're giving away, so that you can factor that into your net effective rent. So, so you know, the question is, you know, how long does this concession game goes on? And for us as bankers, is what net effective rent do you underwrite?
Here's the question, and this, I know it has an effect on Ron. It has an effect definitely on Paulo and Chris. It's the repositioning. You know, a lot of developers, especially younger developers, are taking properties that you may have had a loan on. There's a new buyer over there, and they're saying, you know, I can take this 1-bedroom or studio apartment and make it a 2 or 3 bedroom apartment. Some of it has come to fruition on the projected rents that they have, but it's a risk-reward situation, because you are taking an apartment and you're really reducing the size. How do you and your bank look at that type of project?
Well, something we are somewhat active in. As part of our diversified lending strategy, we do have a pool of money that we go into these transitioning assets. And we're looking for a strong sponsor to be behind it. With some track record, we're going to be having certain reserves set against it. And we're going to look at the location of the property, and we have to get comfortable with that location. We have confidence that it's not going to be a problem re-renting the asset up. Once we're comfortable with all that, we'll work with them, provide them some 2-year money or so, give them a year option, and hopefully we can wind up with the permanent loan on that.
Paulo?
Yeah, we've done a number of repositioning, transitional financing. That's been a good chunk of our business for the past 2 to 3 years. In the past 3 months, however, that at least in our shop, the request for repositioning has sort of slowed down dramatically. So I don't know if that will continue going forward. I don't know if that's a phenomenon in the market, as you know, as pricing has gotten way out of control. So, but that you know, that's a good part of our business.
Chris, Brad?
Yeah, we like that business. I mean, you know, both in the multifamily and the office product. To Ron's point, I mean, you know, you want to do that with the right sponsors, right? Because there is some additional risk involved. But we like the fact that it's not ground up construction. We like the downside protection that you have some cash flow when you start the project. So we like that business.
Yeah, I agree. I don't participate in any of the multi, but on the office side, I love cash flow going in. And most of the time, you're either marking the building to market over a period of several years as rents roll or leases roll, or you're in a situation that just has a large vacancy that needs to be filled. So it's not that hard a business to get your arms around.
In the same vein, when we're talking about that, we're also talking about the phenomena of the co-working, which we briefly discussed in the green room. You know, the WeWorks, the Reguses, the Yards, and all the rest. How, as banks, do you look at that when you're underwriting a loan for both the landlord and, you know, and so on?
Yeah, we've not done much of that, if any, that I can think of, with those tenants in the building. I think it's a relatively new user in the market. I mean, the Regis has been around a long time, but it's certainly, that space has grown a lot in the last, call it 2 years, predominantly with WeWork, and we've yet to execute on a transaction like
Brad?
that.
Yeah, I think it's easy to underwrite a portion of a multi-tenant building that is composed of that sort of user.
A small portion, not
Small portion.
significant portion.
Not significant, at least we haven't done it yet. And I think a lot of people want to see how those businesses perform through a cycle, or the new vintage version of these businesses perform through a cycle. But as a relatively small share of a larger building, I don't think it's
But
an issue.
in the same vein, there's the co-living situation that certain people have. Common has it, and some other companies where it's the co-living. I myself are not an advocate of the co-living concept, because I've always seen co-living in your multifamily type of properties. There's always been people, roommates sharing the apartment. So now they're getting to the next level, where they're sharing, it's furnished, but you don't know who your roommates are. At least when you're going into a multifamily apartment, there may be 3 or 4 leases. For the landlord, I think it's stronger. For the lender, you're more comfortable because you're not a transient housing type of person. So, on that. With regard to that, the hospitality industry has been affected by the Airbnbs of the world, okay? You did a specialty hospitality. Paulo, you're involved with the hospitality, not a specialty, but a unique hospitality. You like a certain type of hospitality. Let's talk about lending to the hospitality market.
So we like portfolios of select service hotels, and that's not the riskiest part of the hospitality sort of landscape. We do very little construction, but where you have properties that have cash flow, where there's an opportunity to enhance the cash flow through investing in the assets, that's a business that seems to be fairly good for us.
Yeah, I mean, we don't do a lot of hospitality lending. We've generally focused on, flagged full-service product acquisitions in kind of major markets with, through an acquisition, there's a PIP program that's put in place, so some value that's being created. It's a small piece of what we do. I think in New York, the hotel market is soft. It feels like every other block you walk by, there's another mid-block limited service hotel that's been developed, and from what I understand, the vacancy is struggled. So.
Paul?
So I have 2 comments. One, Airbnb. I love Airbnb. Every time I go somewhere, and I travel a lot, I book an Airbnb. So I'm not, I'm not a consumer of hospitality. Having said traditional hotel rooms. Having said that, as you pointed out, hospitality in New York City, we have about a $1 billion loan book here in New York City. We have 0 exposure to hospitality. We're in the process of closing a very exciting transaction and can talk about it because we haven't closed it. But I'm a lot more optimistic about hospitality in New York City, provided there's a good sponsor, there's a good operator, and it's and the market of the asset than I have been in the past 5-7 years.
Ron, you're a Flushing-based bank. There's been a lot of hotels in Queens. Has Flushing get involved with the hospitality financing?
No, we really just have a handful that we've done of smaller boutique-type hotels with a sponsor we know and are comfortable with, and very conservative basis. We're not taking the occupancy levels that have been peaking nowadays, so the loan's on a very conservative basis. So we just have a handful.
One comment that everybody brings out is the amount of leverage you can get on a deal. How much leverage will you go to, and how much will you allow in a subordinate manner, with a mezz lender or preferred equity? Chris?
Yeah, I mean, I would say our leverage is probably pretty typical for banks. I mean, we're kind of in the 50 to 65% leverage position. We would allow a little bit more on top of that, for some mezzanine financing. That part of the capital stack is a huge player in the market today, the providers of mezzanine financing.
We'd still like to see equity in deals, so if we do allow mezz, it's probably to the 75% range in most cases.
Paul?
So we can go, we have different lending products. For our permanent multifamily, we can go up to 80%, so on a senior basis. On a construction platform where you do see a lot more of these pref equity, mezzanine situations, we, provided that the mezzanine or the pref equity provider, it's somebody that you can underwrite and you can be comfortable with, we'll definitely allow it in our projects.
So who's your new competition? Is it the private equity funds? Is it, family offices of, developers who have gone in and said they can't get enough real estate to buy, so they're lending? Who do you see as that competition today?
We see insurance companies more these days doing short-term lending in our space, more so than anybody else.
You mean TIAA-CREF type of people?
Yeah, them, MetLife, a few others, sort of playing in shorter-term floating rate space. I mean, the non-banks are more competitive for market risk transactions. The construction, the land, things that have no cash flow, and there's not going to be any recourse. They're taking all of that business, and that's fine. That doesn't fit necessarily within the wheelhouse of the banks. But insurance more and more seems to be playing in the same space.
What about the REITs?
I mean, I see a lot of, to Brad's point, I mean, we don't have a long-term fixed rate product, right? So we do see the private equity or debt funds competing. Also, the families are now in that space. The private owners are, looking for an opportunity to, to buy real estate, through a debt product. So we do see a lot of that in the market.
Yeah, we're seeing a lot of debt funds. I'm going to tell you an example. We're in this condo construction loan. And actually, today or tomorrow, we're getting paid off entirely before construction completion by a debt fund. So they're definitely active. They're hungry for product. And to the extent that, we're getting paid off on a project that hasn't been
What about
completed 100%.
participating with the private equity
The
fund?
delta between bank pricing and the pricing in that market has tightened up extremely tight in the last 12 months. We see the private equity groups as LP investors in a lot of the transactions. I mean, a lot of the joint ventures are, the model's changed in the last decade, right? And these are 90-10 deals, 95-5 deals, and,
Right.
and the private equity folks, we like that because we like their access to capital, to equity capital, when more is needed, in a project.
Now, when I would do the show in 2009, and I would ask, is there money for real estate? At that time, there was a question of saying, no, there's no money in real estate. Or we'd say there was limited money. So I think today, as we say, there is money. Banks continue to be relatively conservative in their underwriting, which is safe. They're not taking the risk. They're not going to the higher level. And things seem shiny for my apple over here. So I'd like to thank Brad, Chris, Paulo, Ron. See you next week.